So bubble tea, it really used to be this super niche beverage, right? Like you would mostly just find it in the back of local Asian supermarkets or, highly specialized
Oh,
neighborhoods.
yeah, completely. It was definitely a hidden gem for a long time.
Right. But today, I mean, it is a multi-billion-dollar global asset class. It's aggressively replacing traditional fast food franchises in commercial real estate portfolios all across the country.
It really is. The shift is massive.
Yeah, and so if you are listening to this right now, you are likely looking for a way to build wealth that, doesn't involve just trading your time for a corporate salary. Or maybe you're an existing business owner looking to expand your portfolio.
Exactly. You're looking for that next scalable thing.
Right. So how exactly did flavored tea and tapioca pearls become like one of the most highly scalable franchise models in the US? Well, today, this deep dive is going to explore the mechanics of a global powerhouse in this space called Chatime.
Yeah, it's such a fascinating one to look at.
It really is. We are going to dissect their unit economics, their real estate strategy, and really the buyer psychology behind why this specific specialty beverage model is attracting such serious investors right now.
Well, I mean, it is a phenomenal case study in franchise mechanics
Mm.
because, when you analyze a business opportunity at this level, you really have to separate the product from the system.
Right. You're not just like making the tea yourself in the back.
Exactly. You are
Okay.
not just buying a job making tea, you are acquiring a localized monopoly on a highly refined system. And the macro shift we are seeing right now, and you touched on this, is investors moving away from full-service food franchises,
Oh, pivoting hard.
pivoting so hard into specialty beverages.
Yeah.
And the reasons are entirely driven by the bottom line and operational simplicity.
Well, yeah, because in a traditional quick service restaurant, I mean, you are dealing with heavy commercial kitchen equipment, grease traps, complex exhaust hoods.
Oh, it's a nightmare. You have the massive liability of hot oil fryers, which means, higher insurance, highly specialized labor, just constant maintenance.
Yeah, the friction is just so high.
Exactly. And specialty beverage eliminates almost all of that friction. You are swapping this heavy culinary operation for what is basically a streamlined assembly line.
And the customer frequency is just completely different, right? Because people might buy a burger, what, like twice a week?
Yeah, maybe twice a week if they really love it.
Right, but a specialty coffee or a premium tea, that becomes a daily habit for a massive demographic.
Precisely. You're tapping into a product category that drives high-frequency habitual purchasing. But what makes this specific brand, Chat Time, so compelling to analyze today is the sheer scale of their proof of concept.
Yeah, their numbers are wild.
They are. I mean, they were established internationally way back in 2005.
Mhm.
So we are looking at a brand that has weathered recessions, supply chain crises, shifting consumer trends, and they have still grown to over 1,000 locations worldwide.
1,000, that's a massive battle-tested infrastructure.
Exactly. But the real arbitrage opportunity here, the reason investors are looking at them so closely right now is their U.S. footprint. They currently have 118 units in the United States.
So they have the operational playbook of this massive global giant, but they still have wide open tier one territorial availability in the American market.
Right. It's a very rare position to be in.
It is. But before we get into the real estate strategies and how you actually scale this thing, we really have to talk about what drives the revenue at the unit level.
For sure, the product itself.
Yeah, because you can have the absolute best real estate in the world, but if the margins on the product don't make sense, I mean, the business fails. So what is actually happening on the menu that makes this so profitable?
So the foundational revenue is built on highly craveable core offerings,
Mm.
right? You've got products like their premium boba milk tea, taro milk tea, brown sugar boba, and the lychee green tea.
Oh, people go crazy for the lychee green tea.
They do. And these are high-margin, consistent sellers. But baseline revenue is really just that, a baseline.
Yeah.
If you want to drive EBITDA, which, is your earnings before interest, taxes, depreciation, and amortization, you need a mechanism that forces continuous consumer engagement.
And without requiring some massive local marketing spend, ideally.
Exactly.
Hmm.
And Shared Time does this through continuous menu innovation. For example, they recently rolled out a June Summer Vibe series, which featured a completely new line of grape drinks, rotating different drink specials throughout the week.
I never really thought about seasonal drinks like streetwear drops, but the psychology is exactly the same, isn't it?
It really is.
Like, when a streetwear brand drops a limited edition sneaker, people line up around the block because they know it is scarce. A seasonal beverage menu does the exact same thing.
Spot on. It creates genuine FOMO.
Yeah, fear of missing out. You are giving the consumer this urgent reason to return this week rather than, say, next month.
Right. And in traditional food franchises, operators usually try to drive traffic with heavy discounts, like,
Yeah.
a dollar menu or a buy one, get one free deal.
Which absolutely kills the unit's profit margins.
It crushes them. But with this drop culture approach to the menu, you maintain premium pricing while still driving aggressive foot traffic.
That is so smart. It's the exact mechanism driving frequency through novelty rather than discounting.
Yeah, but there's a massive operational challenge to that level of menu innovation. And honestly, this is where the franchise model really proves its worth.
How so?
Well, if an independent indie cafe tries to constantly rotate their menu with exotic ingredients, their supply chain turns into an absolute nightmare.
Oh, I can imagine.
Yeah, they are dealing with multiple local vendors, fluctuating prices, completely inconsistent ingredient quality. Chatime has engineered this massive protective moat around their franchisees through their global supply chain and their proprietary tea blends.
Okay, explain exactly how that supply chain creates a moat. Because, literally every franchise claims to have a great supply chain. What does that actually look like for the franchisee's bottom line?
It really comes down to predictability in your cost of goods sold, or your COGS. When you have a global supply chain managed by a franchisor with over 1,000 units, they're negotiating raw material costs at a scale that no independent shop could ever dream of.
Right, the volume is just on another level.
Exactly. They are sourcing proprietary tea leaves and tapioca starch directly from the origin. So they're bypassing the middlemen distributors that just eat up the margins of independent cafes.
Wow, so you're cutting out a huge expense right there.
Yep. And furthermore, it guarantees absolute consistency. Like if you own 5 units across the city, you know that the taro milk tea tastes exactly the same at location A as it does at location E.
Without you ever having to personally taste test the ingredients or haggle with vendors?
Precisely. And think about global shipping bottlenecks. A 1,000-unit giant gets their shipping containers prioritized at the ports, while the indie shop simply runs out of boba.
That is a huge advantage. So that predictability just allows a multi-unit owner to step away from procurement entirely and focus on managing their managers and scouting their next location.
Exactly.
Which is, frankly, the entire point of buying a system. You are paying to not have to figure those things out.
Exactly. You buy back your time.
Right. Which leads us to the most critical part of this deep dive. If the supply chain is doing all the heavy lifting and the menu is effectively marketing itself through these seasonal drops, what is the franchisor actually charging for this plug-and-play system?
Let's break down the unit economics and the costs of entry.
Sure. So the barrier to entry begins with an initial franchise fee of $50,000.
Okay, standard.
Yeah. And when you factor in the physical build-out of the space, the proprietary equipment, your initial inventory, the point-of-sale systems, and working capital, the total investment range lands between $246,708 and $659,788. Wait, hold on. A $650,000 upper limit for a tea shop.
I know, it sounds high.
That sounds incredibly high. I feel like I could buy a top-tier commercial espresso machine, sign a lease on a small storefront, and open an independent cafe for a fraction of that cost. Where is all that capital actually going in a Chatime build-out if it hits that high end?
It is a vital question.
Yeah.
And it really comes down to the difference between buying yourself a low-volume job and building a high-volume asset.
Okay, unpack that for me.
So that upper limit usually reflects a flagship build-out in a premium Tier 1 commercial real estate location. Think like a high-end enclosed mall or a very expensive major metropolitan market where union labor rates for construction are just steep.
Okay, so construction costs play a big role.
Huge role. Plus, you're not just buying a tea brewer, right? You're installing automated high-volume cup sealing machines. You're putting in commercial-grade water filtration systems to ensure the tea extracts perfectly.
Because consistency is everything.
Exactly. You've got specialized high-capacity ice makers and fully integrated point-of-sale tech stacks that talk directly to the franchisor's inventory management systems.
Wow. Okay.
Yeah, an independent cafe built for $150,000 will bottleneck and fail the moment they get a line of 30 people.
Right, because they just can't physically make the drinks fast enough.
Precisely.
Yeah.
A Chatime unit is engineered to process massive volume with incredible speed, so that capital expenditure is buying you capacity and speed of service, which directly translates to revenue.
That makes a lot of sense. You are paying for the throughput. Like if you have the foot traffic, you need the machinery to actually process those transactions before people get tired of waiting and leave.
Exactly.
But beyond the build-out costs, I want to look at the financial requirements of the buyer themselves. The franchisor requires a prospective owner to have a net worth of $500,000 and a liquid cash requirement of $150,000.
Correct. And once you are operating, the ongoing economics include a 6% royalty fee and a 1% ad royalty fee. And that's all structured on a renewable 10-year agreement.
Right. And they offer veteran discounts on the initial fees too, right?
Yes, they do offer discounts for those who have served, which is great.
Awesome. Let's focus on that $150,000 liquid cash requirement for a second, though, because that is real money that needs to be sitting in an accessible account, not tied up in home equity or like a 401k.
Right, it has to be liquid.
Right. And some people new to franchising might look at that and think it is just an arbitrary hurdle to keep people out. Why is that specific financial threshold actually an insurance policy for both the franchisee and the broader brand?
Because it protects against the reality of Murphy's Law in retail business.
Things always go wrong.
Always. Imagine a scenario where a franchisor allows an owner to open with zero capital reserves. They drain every penny they have just to turn the open sign on.
Okay.
Then week 2, the HVAC system on the roof dies, and it costs 10 grand to fix. Yeah. Week 3, they panic about cash flow, so they cut their local marketing budget to pay for the HVAC repair.
Oh, that's a death spiral.
Exactly. Week 4, because they cut marketing, foot traffic dies. Now they're stressing over payroll, so they start scheduling fewer staff members. The customer wait times double, and the unit's reputation in the neighborhood is permanently damaged.
And because their unit is failing, it drags down the perceived value of the entire brand in that region.
Exactly. So that $150,000 liquid requirement ensures that owners have the necessary working capital to survive the critical ramp-up period.
Right, because every new business takes time to reach a break-even point and achieve actual profitability.
Exactly. By requiring strong liquid reserves, Chatime ensures their owners are operating from a position of strength, not desperation.
They can afford to market aggressively, hire the right managers, and weather the inevitable surprises of that first year.
Yep. And from an investor standpoint, this means you are joining a network of financially healthy peers. You aren't going to have neighboring franchisees cutting corners and hurting the brand's premium reputation.
That is such a good point. And what about the ongoing fees? 6% royalty and a 1% ad fund. That is a decent chunk of top-line revenue leaving the business every single month.
It is, yeah. But you have to evaluate what that 7% total is actually buying you.
Okay, what does it buy?
Well, that royalty funds the continuous R&D. It's paying for that global team, figuring out that grape-flavored summer drinks are going to be the next big trend, and then sourcing those ingredients for you.
Oh, right, the seasonal drops we talked about.
Exactly. It also funds the ongoing field support, the tech stack updates, the global brand partnerships. Honestly, you are outsourcing your entire corporate executive team for 6% of revenue.
That's a great way to frame it.
If you tried to hire a marketing director, a supply chain manager, and an R&D chef for an independent business, it would cost you exponentially more than that royalty fee.
Which brings us to the operational reality of actually growing this business because, knowing the unit economics is one thing, but how does the physical footprint actually scale?
This is where it gets really fun.
Yeah. We touched on the difference between a high-end mall build-out and a standard shop, but let's really get into the real estate strategy, especially for someone listening who is, say, a semi-absentee investor, or maybe they already own a portfolio of fitness centers or boutique salons, and they want to add this concept to their mix.
This is arguably the most powerful lever in the Chatime model, highly customizable store footprints.
Okay.
Because when we look at commercial real estate, finding the perfect location is almost always the biggest bottleneck for franchise expansion.
Oh, absolutely.
If you buy into a fast food brand that strictly requires like a 2,500 square foot standalone building with a wraparound drive-through, your growth is entirely capped by the availability of that very rare, incredibly expensive A-tier dirt.
Yeah, you're competing directly with giants like Starbucks and Chick-fil-A for the exact same lots. So how does Chatime bypass that real estate bottleneck?
By offering incredible physical agility. As a franchisee, You are not locked into one rigid building type. You can build out traditional inline stores, which are your standard strip mall locations,
Sure.
but you can also deploy kiosks directly in the center of high-traffic enclosed malls.
Right.
You can build inside non-traditional spaces like university student unions or airport terminals, and yes, you can develop standalone locations if the market calls for it.
I look at that strategy like a real estate Lego set.
Oh, I like that.
Right. If you are a multi-unit owner trying to dominate a specific zip code or county, you don't need identical real estate for every single unit. You snap the pieces together based on what the market gives you.
Exactly.
Like, you might place a high-efficiency kiosk right in the middle of a massive indoor shopping mall to capture that weekend foot traffic. Then, maybe 3 miles away, near a sprawling college campus, you build an inline store where students can actually sit and study.
Right, you adapt to the environment?
Yeah, you are capturing different consumer occasions within the same territory, and you're able to slide into smaller, highly profitable square footage that traditional food concepts simply cannot fit into.
And this ties right back to the operational simplicity we discussed at the very beginning.
The lack of heavy equipment.
Yes. Because you do not have massive fryers, commercial exhaust hoods, or complex grease traps, the build-out in those smaller spaces is vastly less complicated. You aren't dealing with nearly as much zoning red tape or specialized health department hurdles as a concept that's, cooking raw meat.
Which is exactly why this appeals so strongly to the semi-absentee investor.
Oh, completely.
If we are talking about buyer psychology, the phrase semi-absentee gets thrown around a lot in business. But how does this model actually allow an owner to step away from the cash register and manage the business in, say, 5 to 10 hours a week?
It comes down to the reduction of variables. Managing a business semi-absentee means you are managing a manager, not making the product yourself. Because the product relies on highly standardized, proprietary ingredients and automated machinery, like those cup sealing machines and precise hot water towers we talked about. The labor requirement is vastly simplified.
You don't need a head chef.
Exactly. You do not need to hire expensive, specialized culinary staff. You are hiring and training retail staff and baristas. And the franchisor provides comprehensive training across all aspects of operations, which means you have a standardized playbook to train your managers.
That makes it so much more scalable.
It does. Furthermore, the integrated POS systems allow a semi-absentee owner to monitor inventory, labor costs, and real-time sales data from a laptop anywhere in the world.
So you are managing the metrics while your team executes a highly predictable operational loop.
Precisely.
You are building a machine that runs whether you are standing in the store or not. The franchisor provides ongoing field support to ensure those brand standards are met, and the global brand recognition means your local manager isn't having to hustle just to explain to people what the product is.
All right, the marketing ecosystem is already doing the heavy lifting on a macro scale.
Yeah.
It is a highly engineered ecosystem. I mean, think about it. You have a high-frequency, addictive product driven by constant menu innovation. You have a globally secured supply chain that locks in your COGS and prevents stockouts.
Right.
You have a financially sound entry threshold that ensures you are surrounded by well-capitalized peers. And you have a real estate model that adapts to whatever high-traffic opportunities your specific market presents.